Aloha, welcome back to Chapter 7, and what I did here was I redid the presentation for exercise 7-5. What I did prior to this got a little messy, and so I redid it using all three cost flow assumptions that are asked for in the exercise: FIFO, LIFO, and weighted average. And I did all the calculations, and this way I can spend a few minutes just talking about the different calculations. To review, at the top we have the information that's given in the exercise, the beginning inventory and purchases on January 15th as well as January 24th. Now, for each of those three items, we need to have the number of units, the unit cost, and the total cost. And we get total cost by simply multiplying units times unit cost. That gives us total cost. So for the month of January, and keep in mind, we're doing this using the periodic inventory method. Periodic inventory method, where calculations are done at the end of the period. In this case, at the end of the month of January. So for the month of January, our goods available in units and in dollars are shown. We have 700 units available, and the total cost of available units for the month is 6,580. Now below that we show the application of each of the three cost flow assumptions. Keep in mind that a company can decide to use any of the cost flow assumptions, but you cannot mix and match. Whatever cost flow assumption you use to calculate your inventory as well as your cost of goods sold, you need to use that consistently from year to year. You cannot flip-flop from year to year, and you cannot use different cost flow assumptions for different inventories or different items in your inventory within the same year. Another thing to keep in mind is to make a change in your cost flow assumption, you need to get approval from the IRS. So that's something that companies, accountants, and companies need to keep in mind. Anyway, here we go. The first cost flow assumption applied is FIFO, first in, first out, which basically means the earliest inventory on hand or purchased is assumed the first sold. So when we calculate the cost of the 240 units sold, we go to the very top and start counting our way down. So we sold 240, so under FIFO that would be comprised of the beginning inventory, 120 units at $8, and then out of the first purchase for the month, out of this 380, we need another 120 units to make the 240, and those units cost us $9. So when we multiply out these two, when we calculate these two amounts, we get a total of $2,040. Now, to get our ending inventory, we can simply subtract cost of sales from goods available for sale to get ending inventory. Again, as we mentioned a couple of lessons ago, whatever was available for sale at the end of the period was either sold or not sold. So the total of our cost of sales plus ending inventory is always equal to cost of goods available for sale. And of course that applies to dollars as well as to units. However, it's important that we calculate the amount of our ending inventory, just as we calculated the amount of our cost of goods sold. So our ending inventory, when we use first in, first sold, our ending inventory is at the bottom and we work our way up. So our ending inventory then is comprised of the 200 units at $11 a unit, and then out of this 380 we sold 120, so we have 260 left, and those 260 units, the unit cost applicable is $9 a unit. So when we do these two calculations, we can confirm our ending inventory amount of 4,540. Again, the total of our cost of sales plus ending inventory must always equal goods available for sale. Now when we jump to LIFO, LIFO essentially is the opposite cost flow assumption. It basically assumes that the latest goods purchased are the first sold. So when we calculate the cost of those 240 units sold, whereas in FIFO we started at the top and worked our way down, now in LIFO we start at the bottom and work our way up. So for these 240 units sold, we first assume we sold the 200 at $11 each, and then we need another 40, so we get this 40 out of this purchase on January 15th, out of this $380 unit purchase. So when we do these two calculations, our cost of sales is 2,560. Now the same applies to our ending inventory as for FIFO. We can simply subtract cost of sales from goods available to get the ending inventory amount, but it's important that we can calculate it. And again, since for LIFO, since our cost of sales is at the bottom and we work our way up, what's in our ending inventory is the earliest inventory on hand, which would be our beginning inventory, and then we would work our way down. So our ending inventory is comprised first of the beginning inventory units, 120, with a unit cost of $8. And then we have this 380 unit purchase. We had sold 40 of them during the month, and so we have 340 left, and those units cost us $9 each. So when we do these two calculations, we come out with ending inventory of $4,020. And again, when we add these two amounts, cost of sales plus ending inventory, we have to equal our cost of goods available for sale. Notice our cost of sales using LIFO is higher than our cost of sales using FIFO by a little over $500. Now, the book discusses this a little bit. What the book says is during inflationary times, during times of rising prices, which would be inflation, and that's what our scenario here shows. We went from $8 a unit to $9 a unit at mid-month to $11 a unit towards the end of the month. So our unit cost has been rising during the month. When we use LIFO, our cost assigned to units sold is higher than our cost assigned to the ending inventory, because we assume our latest units are sold first. Therefore, under LIFO, during inflationary times, our cost of sales is going to be higher than if we used FIFO. And since cost of sales is an expense, if we have a higher expense, that means our net income will be lower. So let me repeat, during inflationary times when costs are rising, when we use LIFO inventory costing, our costs assigned to sales, our cost of sales are higher, resulting in lower income. And if we have lower income, then our taxes will be lower. So companies that are focused on saving taxes, especially during inflationary times, will, and if they're a merchandiser, will generally use the LIFO cost flow assumption for their inventories. And that's really the reason why when a company wants to make a change in cost flow assumptions for their inventories, they have to get IRS approval, because choice of cost flow assumptions has a direct effect on the amount of income taxes that that business will pay. Okay, so again, assuming inflationary times, we end up with higher cost of sales using LIFO than if we used FIFO. Now, a lot of companies like to be in a compromise position with respect to the amount of net income they show on their income statement and the amount of taxes they pay. Because it can work in both directions. If you're using LIFO during inflationary times, you're going to have lower net income and thus pay less taxes. But at the same time, your financial statements are going to reflect less net income. And so that might not be a good thing when you're trying to impress your banker with your financial statements. So again, a lot of companies maybe want to use a compromise position, and so would oftentimes use weighted average. The way weighted average works is when we calculate our cost of sales as well as our ending inventory, what we do is we average our cost for the period. So for the month of January, our total cost of goods available was 6,580, and our total units available was 700. And so if we simply divide the dollars by the units, we would get an average cost for the month. So when we do that, we come up with $9.40 as our average cost. Now keep in mind, we had inventory at 8, we had inventory at 9, and we had inventory at 11. And so when we do the math, our average works out to $9.40. And so when we use weighted average, we use that average cost to calculate both our cost of goods sold as well as our ending inventory. And so if you notice, our calculated cost of sales under weighted average is $2,256, which is in between the two amounts calculated when we use either FIFO or LIFO. And so again, weighted average would provide us with a compromise position. Keeping in mind, this is we're using the periodic inventory method, where all calculations are done at the end of the period. I hope this has been clear and that it makes sense, was helpful. Thank you for your attention.